Hi everyone, it's Paul Brown here from Wealth21. Hope you're all doing well. I've put together this video at the end of October. We will have a look at the past market returns, but I do want to cover particularly a concept known as the 60-40 portfolio, which has been getting a fair bit of media in financial media of late. So first of all, let's just have a look at the disclaimer. So anything in this video, it's important to recognize this is general information only. It doesn't take into account your specific circumstances. And in particular, I want to highlight that past performance is not a reliable indicator of future performance, because I am going to be talking about a lot of historical returns in this video. So if you have any questions that relate to your particular circumstances, please feel free to give us a call or seek advice from a qualified financial advisor. So let's firstly have a look at the returns as at the 30 September 2022. And it's obviously been a very challenging past 12 months for investors, and in particular in the 2022 calendar year. Over the past 12 months, 6 months, 12 months, there's literally been nowhere to hide except cash, of course. As the share markets have fallen, the property markets have fallen, and also unusually the defensive asset classes, the bond markets, have fallen very heavily as well. Over the longer term though, you see the sorts of trends that we would expect though, which is the growth assets producing the stronger returns over the past 10 years. The listed property and the share market returns have been stronger than the cash and bond returns over the longer term. So let's now move to this concept of a 60-40 portfolio. So it's a hypothetical portfolio, and basically it's made up of the 60% allocated to Australian shares, so it's just the ASX 200, and then 40% allocated to Australian bonds, specifically the Australian 10-year bond. So it's a basic representation of a balanced portfolio, but it's not really a diversified balanced portfolio though, as an Australian investor would typically have some cash, some listed property and some international assets in various sectors. But the aim of this exercise is to show that bond returns would typically provide some protection against negative share returns from year to year through the concept of diversification. So let's look, this is a busy chart, but it's 30 years worth of data for Australian shares, Australian bonds, and for the 60-40 portfolio. And I guess the thing to recognise is that bonds have worked well to provide some protection for investors against negative share market years. For instance, in 2002, the Australian share market was down 4.5%, but the bond market was up 6.2%. So even though there was a slight negative return in 2002, the bonds did work to protect against losses from shares. And the similar thing applied in 2008, 2009, which is the GFC, where the share markets fell pretty heavily, but the bond markets actually went up and provided some protection. And again, in 2020, when the share market fell with COVID, the bond market had a positive return to offset some of those losses. In 2022, though, it's been very unusual because both the share market and this data was actually to 30 June 2022. So we're 4 months down the track now. But to 30 June, both the Australian share market had fallen and the Australian bond market fallen, both by around 10%. So very unusual, and the only example of that happening for an Australian 60-40 portfolio in the past 30 years. When we move on to the US though, we have data going right back to 1928 for their version of the 60-40 portfolio. So the S&P 500 is a broad US share market index, and you've got the US Treasury bonds. And I guess the thing we take away from that is that there's only been 5 calendar years where both shares and bonds have had negative returns. 1931 with the Great Depression, 1941, which is the Second World War, 1969, 2018, and and in 2022 to September. So it's very, very unusual for both shares and bonds to fall in the same calendar year. And in 2022, this is to the end of September, the 60-40 return in the US was negative 21%, which is the worst calendar year performance since 1931 in the depths of the Great Depression. The other thing this chart shows, because we've got so much data, is that you can have consecutive calendar year losses, but it's unusual. Like we saw it for 4 years in a row from 1929 through to 1932 with the Great Depression, 1940-41 with the Second World War, 1973-74, which was the oil shock, and 21-22, which was related to the 9/11 events and the conflict that followed that. So it is possible to have consecutive calendar year losses, but it's not very common. So what do we learn from this data? What do we learn from this history? I mean, it's relatively rare for both share markets and bond markets to fall in the same year, and we've seen that in 2022. Also, consecutive calendar year negative returns for a 60-40 portfolio are also pretty rare and generally associated with some major historical events like a global depression or a war or so on. And we've had a pretty significant global economic disruption with COVID and then the global supply chain issues that we're seeing in 2022 with the Ukraine war, energy market disruption and so on. So it's also relatively likely for markets to recover in the following 3 to 5 years, which prompts investors to be patient with their long-term investment strategy. So I think that's very important. But we do have to remind ourselves that past returns are not necessarily a reliable guide to future returns. So there we have it, a bit of a discussion about the 60-40 portfolio, which is getting a lot of news in financial arenas anyway. So if you have any questions about your investments or what we've covered in this video, please feel free to give us a call. Thank you very much.